I'm George Soros. I've been betting against currencies for over 70 years, and I'm worth about $7 billion. People remember me for breaking the Bank of England in 1992 when I bet $10 billion against the British pound and made over $1 billion in a single day. But what they don't realize is that trade wasn't about the pound. It was about understanding when an artificial currency system becomes unsustainable. Today, I want to talk about something much bigger than the British pound, something that could reshape the entire global financial system over the next decade. I'm talking about the inevitable decline of the US dollar as the world's dominant reserve currency. Now, before you dismiss this as impossible or unthinkable, let me remind you that every dominant currency in history has eventually lost its status. The Portuguese escudo, the Spanish piece of eight, the Dutch guilder, the British pound, they all had their time as the world's primary currency, and they all eventually fell. The dollar has held reserve currency status for about 80 years now, since the Bretton Woods Agreement in 1944. But the foundations that created that dominance are cracking. US debt has exploded to over $34 trillion. Military overstretch is evident worldwide. And most importantly, alternative systems are being built by countries that want to escape dollar dependence. China and Russia have been systematically reducing their dollar holdings. The BRICS nations are developing alternative payment systems. Central banks globally are buying gold at record levels. These aren't random events, they're coordinated efforts to create a post-dollar world. But here's what most people don't understand. Currency collapses don't happen overnight. They happen gradually, then suddenly. And right now, we're in the gradually phase, which means there's still time to position yourself correctly. The question isn't whether the dollar will lose its dominance, it's when and how quickly. And more importantly, for investors like us, it's how to position your wealth to not just survive this transition, but to profit enormously from it. Today, I'm going to show you exactly how I would position for this scenario, not with fear or panic, but with the same analytical approach I used when I saw the British pound's weakness in 1992. Because while currency collapses destroy some fortunes, they create others. The wealth transfer that's coming will be one of the largest in human history. The question is, will you be on the winning side or the losing side? Understanding the historical pattern of reserve currency transition. To understand how to position for the dollar's decline, we must first study the historical pattern of how reserve currencies lose their dominance. This isn't speculation, it's historical analysis of a process that has repeated itself for centuries. The transition from one dominant currency to another typically takes 20 to 30 years and follows a predictable pattern. First comes fiscal overstretch, known as the dominant power spends beyond its means to maintain global influence. Then comes monetary debasement. They print money to finance deficits, weakening the currency's purchasing power. Finally comes geopolitical challenge. Rising powers create alternative systems and reduce dependence on the dominant currency. When Britain was the dominant global power, the pound served as the world's reserve currency for over 100 years. But two world wars, massive debts, and the rise of American economic power gradually eroded sterling's status. The transition didn't happen overnight. It took from 1914 to 1944, 30 years of gradual decline before the dollar officially replaced the pound at Bretton Woods. Today, we're seeing the same pattern with the dollar. The US has been in fiscal overstretch since the 1970s, running persistent deficits to maintain global military presence. Monetary debasement accelerated after 2008 with quantitative easing programs that tripled the money supply. And geopolitical challenges emerging from China, Russia, and other powers building alternative financial systems. The key insight is that reserve currency transitions create massive investment opportunities for those who understand the pattern and position correctly. During the pound to dollar transition, investors who moved capital from British assets to American assets, from sterling to dollars, from London to New York, generated extraordinary returns. Today's transition will likely be more complex because the emerging challenge isn't from a single country, but from a multipolar system. China, Russia, India, and others aren't trying to replace the dollar with their own currencies. They're trying to create a system where no single currency dominates. This multipolar outcome creates different positioning opportunities than previous transitions. Instead of simply moving from one dominant currency to another, investors need to position for a world where multiple currencies, commodities, and alternative assets share reserve status, analyzing current dollar vulnerability indicate. The mathematical foundations of dollar dominance are deteriorating in ways that parallel previous reserve currency collapses. Understanding these indicators helps us gauge the timeline and positioning strategy for the transition. First, debt sustainability metrics are approaching historical danger zones. U.S. debt to GDP ratio has exceeded 130%, levels historically associated with currency crises in other nations. More importantly, interest payments now consume over 15% of federal revenues, creating a debt spiral where borrowing to pay interest becomes necessary. When I analyze currency vulnerability, I focus on the debt service burden relative to tax revenues rather than absolute debt levels. The UK reached similar ratios in the 1930s, just before sterling lost reserve status. Japan reached these levels in the 1990s, triggering decades of economic stagnation. The pattern is consistent. When debt service exceeds a country's fiscal capacity, currency debasement becomes inevitable. A second, trade deficit persistence signals structural economic weakness. The US has run trade deficits for over 40 consecutive years, meaning it consumes more than it produces and relies on foreign financing to maintain living standards. Reserve currency status allows this because other countries need dollars for international trade, creating artificial demand. But this arrangement only works as long as other countries are willing to accept dollars in exchange for real goods. China's $17 trillion economy no longer needs to accumulate dollars for growth. Russia has demonstrated that dollar exclusion doesn't prevent economic function. India is developing rupee-based trade systems. The artificial demand that supports the dollar's value is eroding. Third, monetary expansion has reached levels that historically precede currency crises. Since 2008, the Federal Reserve has increased the money supply by over 300%, from $800 billion to $3.4 trillion in base money. This expansion far exceeds economic growth, meaning each dollar represents less real economic value than before. The temporary nature of this expansion's effects is becoming apparent through persistent inflation despite claims of economic recovery. When currencies lose purchasing power domestically, international confidence follows quickly. The 1970s demonstrated this pattern when dollar devaluation against gold triggered broader international monetary instability. Fourth, geopolitical overstretch mirrors the British experience from 1900 to 1950. Military spending consumes resources without generating economic productivity, creating fiscal drag during periods when economic competitiveness is crucial for maintaining currency status. The US maintains military bases in over 80 countries, operates in multiple simultaneous conflicts, and commits to defense obligations it lacks resources to fulfill sustainably. This pattern preceded every previous reserve currency transition and indicates that maintaining global dominance has become economically counterproductive. The emerging alternative financial architectures. Understanding the alternative systems being constructed by dollar competitors is crucial for positioning strategy because these systems will determine what replaces dollar dominance and where investment opportunities will emerge. China's financial infrastructure development represents the most comprehensive challenge to dollar dominance in history. The Belt and Road Initiative has created trade relationships with over 140 countries, establishing yuan-denominated commerce outside the dollar system. The cross-border interbank payment system, CIPS, now processes over 12 trillion annually, providing an alternative to SWIFT. More significantly, China's central bank digital currency (CBDC) pilot programs are creating the technical infrastructure for direct international payments without dollar intermediation. When completed, this system will allow any country to trade directly with China using digital yuan, eliminating dollar transaction fees and US financial oversight. Russia's response to Western sanctions has accelerated alternative system development in ways that benefit all dollar competitors. The System for Transfer of Financial Messages, SPFS, now connects over 400 Russian financial institutions and is expanding internationally. Russia's gold accumulation program and oil sales in non-dollar currencies demonstrate practical alternatives to dollar dependence. The BRICS expansion to include Saudi Arabia, UAE, Egypt, and other resource-rich nations creates a commodity-backed alternative to dollar hegemony. With these members, BRICS controls over 40% of global oil production and 50% of global gold reserves, providing the foundation for commodity-backed currency systems. India's Unified Payments Interface, UPI, is being internationalized to facilitate rupee-based trade with multiple countries. Brazil and Argentina have discussed common currency arrangements. Iran and Russia conduct significant trade in local currencies and gold. These bilateral arrangements are building the foundation for multilateral systems that exclude the dollar. The technical infrastructure being created isn't just about avoiding US sanctions, it's about reducing transaction costs, eliminating currency conversion fees, and escaping dollar volatility in international trade. Countries that adopt these systems often discover they're more efficient than dollar-based alternatives. For investors, this infrastructure development creates opportunities in the currencies, commodities, and assets that will benefit from reduced dollar dependence. Positioning early in these alternatives, before widespread adoption occurs, offers asymmetric return potential similar to dollar positioning during the 1940s transition. Strategic asset allocation for currency transition. Based on historical analysis and current alternative system development, I would construct a portfolio designed to benefit from dollar decline while maintaining downside protection if the transition takes longer than expected. The core holding would be physical gold, representing 25–30% of the portfolio. Gold has served as the ultimate store of value during every previous currency transition and is being accumulated by central banks at record levels as they diversify from dollar reserves. But this isn't just about gold's historical role. It's about gold's function in the emerging multipolar monetary system. Unlike previous transitions, where one currency replaced another, the emerging system appears to be gravitating toward gold as a neutral settlement mechanism between competing currencies and trading blocs. China, Russia, and other BRICS nations are accumulating gold specifically to establish credibility for their alternative payment systems. Gold provides the trust mechanism that allows countries to trade without accepting each other's currencies. The second allocation would be foreign currencies from countries with strong fiscal positions and commodity resources, representing 20–25% of the portfolio. The Swiss franc, Norwegian krone, Canadian dollar, and Australian dollar offer exposure to resource wealth and conservative fiscal management. The Singapore dollar provides exposure to Asian growth without direct Chinese political risk. But the most interesting currency opportunity might be emerging market currencies from countries that are successfully reducing dollar dependence. The Indian rupee, Brazilian real, and Russian ruble could outperform dramatically if their alternative payment systems gain widespread adoption. The risk-reward profile favors small positions that could multiply if dollar alternatives succeed. Third would be commodity exposure through both physical assets and commodity-producing equities, representing 20% of the portfolio. Agricultural land, energy infrastructure, and mineral resources maintain value regardless of currency fluctuations and often appreciate during monetary transitions as investors seek inflation protection. Energy infrastructure is particularly attractive because it generates cash flows in local currencies while serving essential economic functions. Renewable energy assets in countries with strong rule of law could benefit from both energy transition trends and currency diversification needs. Fourth would be real estate in politically stable countries with strong property rights, representing 15% of the portfolio. Swiss, Canadian, and Australian real estate provides currency diversification while offering inflation protection. Real estate investment trusts, REITs in these countries offer liquidity while maintaining real asset exposure. The final allocation would be cryptocurrency exposure, representing 5–10% of the portfolio. While volatile and speculative, Bitcoin and other decentralized currencies offer the possibility of extreme returns if they gain adoption as dollar alternatives. The risk is high, but the potential return justifies a small allocation in a currency transition scenario. The key principle is diversification across assets that maintain value independent of dollar strength while offering upside exposure to dollar alternatives. This allocation protects wealth if dollar decline is gradual, while positioning for significant gains if decline accelerates. Cryptocurrency and digital currency positioning. The emergence of digital currencies creates unprecedented opportunities and risks during this currency transition because they represent both a challenge to all existing currencies and a potential new form of monetary system entirely. Bitcoin's value proposition as digital gold becomes compelling during currency transitions because it offers many of gold's benefits: limited supply, international portability, independence from any government, while solving gold's practical limitations like storage costs and transaction difficulties. But Bitcoin's 15-year track record is insufficient to predict behavior during a major currency crisis. Will governments tolerate Bitcoin adoption if it threatens their monetary control? Will technical limitations prevent Bitcoin from serving as a practical alternative to dollars in international commerce? Will environmental concerns or energy costs make Bitcoin unsustainable? Despite these uncertainties, Bitcoin's price performance during recent monetary expansion suggests it could serve as an effective hedge against currency debasement. The correlation between Bitcoin prices and money supply growth indicates that sophisticated investors already view it as a monetary alternative rather than just a speculative asset. Central bank digital currencies, CBDCs, represent a different opportunity because they combine government backing with digital currency efficiency. China's digital yuan pilot programs suggest CBDCs could facilitate international trade more efficiently than existing correspondent banking systems, reducing costs and settlement times. If CBDC adoption expands internationally, it could accelerate dollar decline by making alternative currencies more practical for international commerce. Countries currently using dollars primarily for transaction convenience rather than preference might switch to digital alternatives that offer similar convenience without political risk. The investment strategy for digital currencies requires acknowledging both enormous potential returns and high probability of total loss. A small allocation to Bitcoin provides asymmetric upside if cryptocurrency adoption accelerates during dollar decline. But this allocation must be sized to survive complete loss without affecting overall portfolio objectives. Ethereum and other programmable currencies offer different risk-return profiles because they enable smart contracts and decentralized finance applications that could replace traditional banking functions. If dollar decline disrupts traditional financial systems, decentralized alternatives could gain adoption rapidly. The timing question for cryptocurrency positioning is critical because digital currency regulation could change dramatically as governments respond to currency competition. Early positioning offers maximum return potential, but also maximum regulatory risk. Geographical diversification strategy. Dollar decline will affect different regions differently, creating opportunities for investors who understand how currency transitions reshape global economic geography and position accordingly. Asia represents the largest opportunity because it's developing the most comprehensive alternatives to dollar-dependent systems. China's economy is already large enough to support yuan internationalization, while India's growth trajectory suggests the rupee could become regionally significant. Southeast Asian countries are developing intra-regional trade systems that reduce dollar dependence. But Asian positioning requires careful country selection because not all Asian economies will benefit equally from dollar decline. Countries with strong domestic demand and competitive export industries will thrive, while those dependent on dollar-denominated debt could face crises during currency transition. Europe offers stability but limited upside because European integration creates a large, stable economic bloc that could maintain prosperity regardless of dollar status. The euro already serves as an alternative reserve currency, and European financial infrastructure is sophisticated enough to handle increased international role. European positioning works best through assets that benefit from increased European autonomy: defense contractors, energy infrastructure, technology companies developing European alternatives to American systems. The goal is benefiting from European independence rather than simple exposure to European growth. Resource-rich countries offer commodity exposure with currency diversification, but political risk analysis becomes crucial because resource wealth attracts geopolitical interference. Canada, Australia, and Norway combine resource wealth with stable governance, while Brazil, Russia, and Middle Eastern countries offer higher returns but greater political risk. The optimal geographical allocation depends on risk tolerance and return objectives, but diversification across multiple regions provides protection against regional political risks while maintaining global growth exposure. Risk management during currency transitions. Currency transitions create unique risk management challenges because traditional hedging relationships break down when the fundamental monetary system changes, requiring specialized approaches to portfolio protection. Liquidity risk becomes paramount because currency crises often trigger capital controls, market closures, and banking restrictions that can trap capital regardless of asset quality. The 2008 financial crisis demonstrated how quickly global liquidity can disappear, while recent Russian sanctions showed how political considerations can override property rights. The solution is maintaining higher cash reserves than normal and diversifying cash holdings across multiple currencies and jurisdictions. Swiss banks, Canadian banks, and Singapore banks offer political stability and currency diversification for liquid reserves. Counterparty risk increases because financial institutions face stress during currency transitions, potentially creating defaults even in apparently safe investments. Bank deposits, insurance contracts, and pension obligations all depend on institutional stability that can't be guaranteed during monetary upheaval. Reducing counterparty risk requires favoring direct asset ownership over financial institution liabilities. Physical precious metals, direct real estate ownership, and dividend-paying stocks offer returns without depending on financial institution performance. Timing risk is unavoidable because currency transitions are impossible to predict precisely, but position sizing can minimize the cost of being early while maximizing benefits from being correct about direction. The strategy is building positions gradually over time, rather than making large, concentrated bets based on specific timing predictions. This approach allows investors to benefit from correct directional analysis while minimizing the impact of timing errors. Regulatory risk could be enormous because governments facing currency crises often implement capital controls, price controls, and asset confiscation programs to maintain power. Historical precedent includes gold confiscation, US 1933, currency conversion requirements, multiple countries, and wealth taxes, various European countries. Managing regulatory risk requires geographic diversification, asset diversification, and maintaining options for rapid capital mobility if political circumstances deteriorate. Multiple citizenship, offshore accounts, and internationally portable assets provide flexibility during political stress. Execution timeline and implementation strategy. Successful positioning for dollar decline requires understanding that currency transitions follow irregular timelines with periods of acceleration and deceleration, making timing precision impossible, but directional preparation essential. The gradual phase could last 5-10 more years as alternative systems develop capacity and credibility, while dollar decline remains manageable. During this phase, diversification away from dollar assets generates modest returns while providing protection against acceleration. The acceleration phase could compress several years of decline into months or weeks as psychological and reflexivity factors amplify fundamental weaknesses. Historical precedent suggests this phase generates the largest investment returns, but requires maintaining positions through extended periods of gradual change. Implementation should begin immediately with the lowest risk, highest conviction positions, physical gold, foreign currency, cash reserves, and real estate in stable jurisdictions. These positions provide immediate downside protection while maintaining upside potential throughout the transition timeline. Higher risk positions like emerging market currencies, commodities, and cryptocurrencies should be added gradually as alternative systems demonstrate viability and current dollar weakness becomes more apparent. This staged approach maximizes long-term returns while managing short-term volatility. The most speculative positions Individual country currencies, specific commodity bets, early-stage cryptocurrency projects should represent the smallest allocations, but offer the highest potential returns if currency transition accelerates beyond current expectations. Regular rebalancing becomes crucial because relative performance between different alternatives will vary significantly as political and economic conditions change. The goal is maintaining exposure to multiple potential winners rather than betting everything on a single outcome. Psychological preparation for currency collapse. The psychological challenges of positioning for currency collapse are often more difficult than the technical challenges because it requires betting against the financial system that has created most investors' wealth and understanding. Currency transitions violate most investors' experience because the dollar has been stable and dominant throughout their investing careers. The idea that this system could change fundamentally challenges basic assumptions about how money and markets work. But psychological comfort with current systems can prevent rational analysis of their sustainability. The British investors who couldn't imagine sterling losing reserve status missed opportunities during the 1920s and 1930s to position for American dominance. The key insight is that currency systems are human creations that change when underlying conditions change, not natural laws that persist forever. Understanding this historical perspective helps maintain objectivity when analyzing current dollar sustainability. Maintaining conviction during the gradual phase requires focusing on underlying trends rather than daily market movements. Alternative system development, central bank gold purchases, and bilateral trade agreements often receive little media attention but indicate fundamental changes in global monetary architecture. The reflexivity principle applies to currency transitions because perception and reality influence each other continuously. Dollar strength can persist beyond fundamental justification because of perception and habit, while dollar weakness can accelerate beyond fundamental weakness because of psychological factors. Successful currency transition. Investing requires patience during gradual phases and decisiveness during acceleration phases. The biggest mistakes typically involve either premature selling during volatility or failure to maintain positions during extended periods of apparent stability. Final implementation. Recommendation. Based on 7 decades of currency analysis and successful speculation, my recommended approach to positioning for dollar decline emphasizes asymmetric risk-reward while maintaining practical portfolio management principles. Start with a 25% allocation to physical precious metals, primarily gold, but including some silver for smaller transaction utility. Store metals in multiple jurisdictions with stable rule of law. Switzerland, Canada, Singapore to avoid confiscation risk while maintaining access. Add 25% allocation to foreign currencies and foreign cash equivalents, emphasizing countries with strong fiscal positions and commodity resources. Swiss francs, Norwegian kroner, Canadian dollars, and Singapore dollars provide stability, while smaller positions in emerging market currencies offer higher return potential. Include 20% allocation to real assets in politically stable countries, agricultural land, energy infrastructure, real estate investment trusts. Focus on assets that generate cash flows in local currencies while serving essential economic functions. Maintain 20% allocation to stocks in companies that benefit from dollar decline, foreign multinationals, commodity producers, alternative payment system developers. Emphasize companies with strong competitive positions and pricing power during inflationary periods. Reserve 10% allocation for high-risk, high-return alternatives, cryptocurrency, distressed foreign assets, early-stage companies developing dollar alternatives. Size these positions to survive total loss while offering asymmetric upside if currency transition accelerates. The timeline for implementation should extend over 12-18 months to average into positions and avoid concentration in temporary market conditions. Regular rebalancing maintains target allocations as relative performance changes. Remember that currency transitions create wealth transfers rather than wealth destruction. While some investors will lose enormously, others will gain proportionally. The question isn't whether change will occur, but whether you'll position to benefit from inevitable transition. This framework has guided my approach to currency speculation throughout my career. The specific assets and allocations may evolve as conditions change, but the principle remains constant. Understand fundamental trends, position before they become obvious, and maintain discipline during inevitable volatility. The dollar's decline as reserve currency is already beginning. The only question is whether you'll position to benefit from this historical transition or watch it happen to your disadvantage.